For most people, the price of silver feels simple. You open a chart, see a number quoted in dollars, and assume that's the price of silver everywhere in the world. One metal, one global market, one price. But that assumption is becoming increasingly wrong. Right now, silver is trading at different prices in different parts of the world, not by a few cents, but by amounts large enough to matter. In New York and London, silver trades at one level. In Shanghai, the same metal often trades at a noticeable premium. That shouldn't happen in a perfectly functioning global market. Silver is dense, standardized, and internationally traded. If prices diverge, traders should buy where it's cheap, sell where it's expensive, and erase the difference. That's how global markets are supposed to work. So why isn't that happening? Why does Shanghai keep paying more for silver, even when Western markets say supply is plentiful? And why do silver prices increasingly seem to move after Asian trading sessions, not before? To answer these questions, we need to rethink what the silver market actually is, and more importantly, what it has quietly become. Because silver today is not just a precious metal traded by investors. It is also a critical industrial input consumed every day by the modern economy. And when a metal is both financial and industrial, the place where it's physically used eventually matters more than the place where it's financially traded. That's the shift we're witnessing now. For decades, the global silver price was shaped primarily by Western financial markets, futures exchanges where massive volumes of silver contracts changed hands daily. These markets were liquid, fast, and highly efficient at one thing: trading paper claims. But efficiency on paper doesn't always mean accuracy in reality. When physical demand is stable and inventories are plentiful, paper markets can dominate price discovery without issue. But when demand tightens, inventories shrink, and delivery starts to matter again, the balance begins to shift. And that shift doesn't announce itself with headlines. It shows up quietly, in premiums, in delivery behavior, and in who the market starts listening to. Shanghai is becoming important not because it wants to replace Western markets, but because it is pricing silver based on a question that paper markets often ignore. Can you actually get the metal? That question changes everything. In the next part, we'll step back and look at how silver pricing worked for most of the modern financial era, and how the system that once set the global price was built on assumptions that no longer fully hold. To understand why Shanghai is becoming so important today, we first need to understand how silver was priced for most of the modern financial era. For decades, the global silver price was not set by people buying bars and coins. It was set by financial markets, specifically futures exchanges based in the West. The most influential of these were in the United States and Europe, where silver futures contracts became the primary way price was discovered. A futures contract is simple in theory. It's an agreement to buy or sell silver at a future date at a price agreed upon today. These contracts were originally designed to help miners and industrial users manage risk. A miner could lock in a selling price. A manufacturer could lock in a buying price. But over time, something changed. Futures markets became less about hedging physical metal and more about trading exposure. Banks, hedge funds, and speculators entered the market not because they wanted silver, but because they wanted to profit from price movements. This led to a situation where enormous volumes of silver contracts were traded every day, far more silver than could ever realistically be delivered. And that wasn't seen as a problem, because most participants never intended to take delivery. They would close their positions, roll them forward, or settle in cash. As long as confidence in the system remained high, this worked smoothly. The price on these exchanges became the global silver price. News outlets quoted it, mining companies referenced it, investors trusted it. In effect, the silver market became a price of paper silver, not necessarily physical silver. But here's the key assumption this system relied on. It assumed that physical silver would always be available in the background, that if someone did want delivery, the metal would be there, that inventories were sufficient, that shortages were temporary. As long as that assumption held, paper markets could dominate price discovery without friction. And for many years, they did. But assumptions only matter until reality challenges them. And over the past several years, the physical silver market has been doing exactly that. In the next part, we'll look at what changed, specifically how rising industrial demand and structural supply constraints began to stress a system that was built for abundance, not scarcity. For a long time, the silver market operated under conditions of relative abundance. Mining supply was steady. Inventories were large enough to absorb shocks. Industrial demand, while important, grew gradually. In that environment, paper markets could dominate pricing without serious consequences. Physical silver acted like a quiet foundation, always there, rarely questioned. But that balance has been changing. The first major shift came from industrial demand. Silver is not just a store of value. It is one of the most electrically conductive metals on Earth, highly reflective and resistant to corrosion. Those properties make it essential for modern technology. Every smartphone, solar panel, electric vehicle, data center, and medical device uses silver in some form. And unlike gold, most silver used in industry is not recycled efficiently. Once it's embedded in electronics or dispersed in tiny amounts, recovering it becomes uneconomical. That means silver is consumed. As the global economy became more electrified and digitized, silver demand began to rise faster than many expected. Solar energy alone became a major source of new demand, requiring large volumes of silver for photovoltaic cells. At the same time, mining supply struggled to keep up. Silver is rarely mined on its own. Most of it is produced as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply does not respond quickly to higher prices. Even if silver prices rise, miners can't instantly produce more unless the primary metal economics also make sense. This creates a structural problem. Demand can rise quickly. Supply responds slowly. For a while, the gap was filled by above-ground inventories. Stockpiles built up over decades quietly made up the difference. But inventories are finite. And when a market quietly draws down inventories year after year, something eventually changes. Not all at once, but gradually. More buyers begin to ask questions. Is the metal really there? How much is left? What happens if more people want delivery at the same time? This is where paper markets begin to feel stress. Because paper contracts assume abundance. Physical markets reveal scarcity. And as scarcity becomes visible, the center of gravity shifts toward markets that prioritize delivery, not just trading. That's the environment in which Shanghai's role starts to grow. In the next part, we'll look at why China views silver differently from Western financial centers, and how that difference in perspective reshaped where real price discovery happens. To understand why Shanghai is gaining influence in the silver market, we need to understand how China thinks about commodities in general. Western financial markets tend to view commodities primarily as financial assets. They're something you trade, hedge, speculate on, or include in a portfolio. Even when commodities have real-world uses, the market structure often prioritizes liquidity and price efficiency over physical security. China approaches commodities from a different starting point. For China, commodities are inputs into national capability. Silver is not just something that goes up or down in price. It is a material that feeds manufacturing, energy infrastructure, electronics, defense technology, and long-term economic planning. That difference in mindset matters. When you see silver as an investment, you care about charts, trends, and returns. When you see silver as an input, you care about availability, reliability, and continuity of supply. China is the world's largest manufacturer of electronics and one of the largest producers of solar panels, electric vehicles, and advanced industrial equipment. All of these require silver. That means China's priority is not just price, it's access. Can silver be sourced consistently? Will it be available during periods of global stress? What happens if financial markets freeze but factories still need metal? These are not abstract questions, they are operational ones. This is why China has spent years building commodity markets that are more closely tied to physical delivery. It's also why Chinese authorities pay close attention to strategic materials and do not leave them entirely to unrestricted market flows. This doesn't mean China rejects markets. It means it structures them differently. In this framework, a silver market that allows massive paper trading without sufficient attention to delivery risk is incomplete. It may provide price signals, but it does not provide security. Shanghai's growing importance comes from the fact that it answers a different question than Western exchanges. Not what is the cheapest price right now, but at what price can silver actually be obtained in size when needed? That question becomes far more important in a world where supply chains are fragile, geopolitical tensions are rising, and industrial demand is structurally increasing. In the next part, we'll look more closely at how the Shanghai silver market works in practice, and why its emphasis on physical settlement changes the way prices behave. At first glance, the Shanghai silver market doesn't look radically different from Western exchanges. There are futures contracts. There are traders. There are daily prices moving up and down. But the difference is not in the surface mechanics. It's in what the market expects participants to do. In Western futures markets, delivery is the exception. In Shanghai, delivery is treated as a real and meaningful outcome. That single difference changes behavior. When traders know that a contract can realistically end in physical delivery, they approach risk differently. Excessive leverage becomes dangerous. Short positions carry more weight. Inventory levels suddenly matter. This naturally ties the paper price more closely to physical availability. If supply is abundant, prices behave calmly. If supply tightens, prices respond faster, because the market can't rely on endless paper selling to suppress signals. This is why Shanghai prices often move before Western prices. During Asian trading hours, when Shanghai is active and Western markets are quiet, silver frequently establishes direction. When Western markets open later, they often react to what has already happened. This reversal of leadership is subtle but important. For decades, Asia followed Western pricing. Now the flow increasingly runs the other way. Another key feature is transparency around inventory and delivery activity. While no market is perfectly transparent, Shanghai places greater emphasis on tracking where metal is and how much is moving. That creates a tighter feedback loop between demand, availability, price. And that feedback loop is what defines real price discovery. The result is a market that is less tolerant of artificial abundance. You can trade paper silver, but only up to the point where physical reality pushes back. That's why Shanghai prices often carry a premium. not because the market is inefficient, but because it is pricing what silver is actually worth when delivery matters. In the next part, we'll focus on that premium itself, what it represents, why it persists, and why it's one of the clearest signals that the center of silver pricing is shifting. One of the most misunderstood aspects of the silver market today is the Shanghai premium. When people first hear that silver trades at a higher price in Shanghai than in Western markets, the instinctive reaction is to assume inefficiency. Maybe it's a temporary imbalance. Maybe it's a reporting quirk. Maybe it's just noise. But persistent premiums are rarely random. In well-functioning global markets, price differences only exist when something is preventing easy arbitrage. And in the silver market, that something is physical friction. Silver is heavy. It must be assayed, insured, transported, and cleared. It moves across borders under regulatory oversight. All of that takes time and money. When Shanghai silver trades at a premium, it's signaling that the metal is more valuable where it is being used than where it is being traded on paper. In other words, the premium is not speculation, it's a scarcity signal. It reflects the real cost of sourcing additional silver when demand rises. If buyers in China need metal immediately, they are willing to pay more rather than wait for weeks of shipping and approvals. This tells us something important. The market is no longer assuming that silver is instantly available everywhere at the same price. That assumption, which paper markets depend on, is quietly breaking down. Another key detail is persistence. Short-lived premiums can be dismissed, but when premiums last weeks or months, they reveal a structural imbalance. They tell us that local demand is strong, supply is tight, and paper prices elsewhere are not fully reflecting physical conditions. This is why analysts increasingly watch Shanghai prices as a leading indicator. Not because Shanghai sets prices by decree, but because it reveals stress earlier. When physical demand rises, Shanghai responds first. When supply tightens, Shanghai shows it sooner. Western markets tend to adjust later, once physical signals can no longer be ignored. In the next part, we'll explore why arbitrage doesn't instantly eliminate this premium, and what that tells us about the limits of paper-driven pricing. In theory, price differences like the Shanghai premium shouldn't last. If silver is cheaper in one market and more expensive in another, traders should buy where it's cheap, sell where it's expensive, and pocket the difference. That process, arbitrage, is supposed to force prices back into alignment. So why hasn't that happened? The answer lies in the difference between financial arbitrage and physical arbitrage. Financial arbitrage is fast. It happens in milliseconds. It involves numbers on screens. Physical arbitrage is slow. It involves metal, paperwork, approvals, logistics, and time. To arbitrage the silver premium physically, a trader would need to acquire large quantities of deliverable silver in the West, arrange transport, insurance, and financing, navigate export and import regulations, deliver the metal into approved facilities in China, and do all of this fast enough for the price difference to still exist. That's not a simple trade, it's a supply chain operation. And when demand is urgent, time matters more than price. If a manufacturer needs silver now, not in 6 weeks, paying a premium is rational. That urgency defeats arbitrage. There's also scale to consider. Small price differences might not justify the cost and risk of moving metal across the world. Only large, persistent premiums attract serious physical arbitrage. And even then, capacity is limited. This exposes a deeper truth. Paper markets assume instant liquidity. Physical markets operate on real-world constraints. As long as silver pricing was dominated by paper trading, those constraints were invisible. But as physical demand increases, they become central. And when constraints matter, the market that deals with them directly becomes more influential. That's why the Shanghai market's signals can persist without being arbitraged away. They're not pricing theory, they're pricing reality. In the next part, we'll look at how rising delivery pressure and margin changes in Western markets fit into this picture, and why they often appear at the same time physical premiums widen. When physical demand starts to matter more, stress shows up in places that paper markets can't hide. One of the first signs is delivery pressure. In a calm market, most futures contracts are closed out long before delivery. Traders roll positions forward, settle in cash, or offset trades. Physical silver quietly stays in vaults. But when confidence shifts, behavior changes. More participants begin to ask for delivery. More contracts move closer to settlement. Inventory levels suddenly matter. This is when paper-heavy markets face a problem. If too many people demand delivery at once, the system relies on trust. Trust that inventory is sufficient, that logistics will work, and that contracts can be honored smoothly. To manage this risk, exchanges often raise margin requirements. On the surface, margin hikes are framed as routine risk management. Higher volatility means higher margins. That's the explanation. But margins also have another effect. They reduce leverage. They force weaker hands out of the market. They discourage aggressive speculation. In other words, margin hikes are a way of cooling paper activity when physical stress is rising. This pattern has repeated many times across commodity markets. When delivery pressure increases, paper markets respond defensively. The important point is not that margin changes are sinister or conspiratorial. It's that they reveal where stress is occurring. Paper markets become cautious when physical reality threatens to intrude. And that's exactly when markets like Shanghai become more influential, because they don't try to smooth over delivery signals. They absorb them directly. This is why periods of rising physical premiums often coincide with increased volatility, higher margins, reduced paper liquidity. All of these are symptoms of the same underlying shift. The silver market is slowly moving from a world of assumed abundance to a world where availability must be proven. In the next part, we'll zoom out and look at how industrial buyers respond to this environment and why their behavior quietly removes silver from the open market altogether. While traders debate prices and analysts argue over charts, the most important players in the silver market often operate quietly in the background. Industrial buyers. These are not hedge funds or speculators. They are manufacturers who need silver to keep production lines running. For them, silver is not an investment thesis. It's a non-negotiable input. If silver isn't available, factories slow down or stop. That risk is far more damaging than paying a slightly higher price. As physical tightness becomes more visible, industrial buyers adjust their behavior. They don't chase daily prices. They don't wait for pullbacks. They don't rely on spot markets alone. Instead, they secure supply. This can take several forms. Long-term contracts with producers, direct agreements with refiners, pre-funded supply arrangements, strategic inventory buildup. Every ounce secured this way is an ounce that never reaches the open market. This is critical. Paper markets assume that metal flows freely into exchanges. Industrial buyers break that assumption by locking silver upstream before it ever becomes tradable. This behavior is especially pronounced in regions with heavy manufacturing concentration. When thousands of factories depend on a steady flow of silver, supply security becomes a strategic priority. China fits this profile perfectly. As more silver is tied up in long-term industrial channels, the remaining pool available for trading becomes smaller. That doesn't always show up immediately in headline supply numbers, but it shows up in behavior. Premiums rise. Delivery times lengthen. Inventories become sticky. And markets that rely on physical settlement begin to reflect this reality sooner than paper-driven markets. This is another reason Shanghai's role is growing. It sits closer to the point of consumption. It feels industrial demand directly, not abstractly. When manufacturers step in and quietly absorb supply, Shanghai prices adjust, not because of speculation, but because the metal is already spoken for. In the next part, we'll examine how state oversight and export controls reinforce this shift, and why managing silver flows has become a strategic concern, not just a commercial one. When people hear about export controls or licensing requirements on silver, the reaction is often dramatic. China is banning silver exports. There's a lockdown. A global squeeze is coming. In reality, the truth is more subtle and more important. Export controls are not about stopping trade altogether. They're about prioritizing domestic needs and tracking strategic materials more closely. From a state's perspective, this makes perfect sense. Silver is a critical input for energy transition infrastructure, advanced electronics, defense-related manufacturing, strategic supply chains. Allowing unrestricted outflows of such material, especially during periods of tightening supply, creates vulnerability. So instead of blanket bans, governments use tools like export licensing, approved exporter lists, reporting requirements, administrative approvals. These tools don't eliminate exports, they slow them down and make them intentional. And slowing things down matters. Remember, physical arbitrage depends on speed. Delays weaken arbitrage. Uncertainty raises risk. Even modest administrative friction can keep price differences in place. This reinforces the Shanghai premium and strengthens the role of local pricing. When silver stays closer to where it's used, the market that serves those users becomes more influential. Another important point is signaling. Export controls send a message to domestic buyers. We're watching this market. We care about availability. Don't assume unlimited access. That encourages early action, securing supply now rather than later. And once buyers begin acting defensively, the market structure changes. Silver becomes less liquid. More supply is spoken for in advance. Open market pricing reflects scarcity sooner. In the next part, we'll connect all these pieces together and explain why this shift doesn't mean Western markets disappear, but why they no longer sit at the center of silver price discovery. At this point, it's important to be very clear about what is and is not happening. Shanghai is not replacing Western silver markets overnight. COMEX and London are not suddenly irrelevant. Paper trading is not disappearing. What is happening is more subtle and far more powerful. Silver price discovery is becoming multi-centered, and the center that matters most is the one closest to physical demand. For decades, Western markets dominated because they were liquid. They were trusted. They were assumed to represent reality. That worked when physical supply was abundant and delivery was rarely questioned. But as soon as the market begins asking, where's the metal? Authority shifts toward the markets that answer that question directly. Shanghai doesn't dominate because of ideology or politics. It dominates because it sits at the intersection of manufacturing demand, physical delivery, Strategic resource planning. In other words, it prices silver the way users experience it, not the way traders model it. This changes the information flow. Instead of Western prices leading and Asia reacting, we increasingly see Asian sessions establish direction. Physical premiums signal stress. Western markets adjust later. It's not a conspiracy, it's a feedback loop. Markets that feel pressure first speak first. This also explains why Western investors sometimes feel confused. Charts look calm, sentiment looks neutral, yet physical signals suggest tightness. Both can be true at the same time. Paper markets reflect expectations. Physical markets reflect conditions. When those two diverge, the market that deals with conditions eventually wins. In the next and final part, we'll step back and answer the core question directly. Why this matters, what it means for the future of silver, and what lesson this shift teaches us about how global markets really work.